Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with Aniket Ullal, who's the head of ETF Research and Analytics at CFRA Research. So, Aniket, you wrote recently a very interesting piece that I want to talk about today. It's related to ETF classification, but before we get into that, you made a really interesting observation in which you said that all of these changes you're seeing with regard to fund classification stem from fee-based investment advice. Can you tell us about, why that led to changes in fund classifications?
If we look at the wealth management industry to 20 or 30 years ago, it was a very commission-based industry, right? We had a situation where advisors were effectively getting paid commissions or were getting paid by the fund companies to promote certain products. And investors were really pushing back on that. And we've seen over the last 15, 20 years, a real growth in fee-based, and I don't call it fee only because sometimes it's fee-based combined with commission, or kind of in a hybrid model, but essentially a model where the advisor gets paid on the assets that they're managing as opposed to getting paid on by the product providers. And obviously that works well for the investor, that works well for the advisor, assuming they're successful in growing their asset base. And that has really been one of the fundamental drivers of growth in the ETF industry. Because if I'm an advisor who's getting paid in commission, I have an incentive to essentially, include in the portfolio higher fee products. Whereas if I'm getting paid just on fees on the overall assets, I have an incentive to use lower cost products. I don't necessarily need to use higher cost products. And that shift has been very core to the growth in the ETF industry, particularly with iShares, BlackRock, kind of growing in that segment. So I would say all of these trends are very connected. And as we look at the growth in the ETF industry, we have to see it in the context of how the advice industry itself has changed.
Really interesting. So, Aniket, in your piece, you noted that the way that classification systems work in terms of, funds and things like that, it used to be style boxes and sectors and things like that. But you're saying those are outdated in today's world. Can you talk about why they're outdated?
The primary reason they're outdated is because if we look at the way the reason style boxes were developed, they were primarily developed for evaluating active mutual funds. And really the question investors and advisors were asking is, which star fund manager can I find? Which fund manager can I find who's going to beat a particular benchmark? And so really the relevant question was, okay, which box does a fund belong in? And how is that fund then performing against the benchmark for that box? So is it a large cap value? Is it small cap growth? Is it mid cap blend? And therefore, how is that fund performing relative to that benchmark? With the growth in ETFs, we've actually seen that's not really the relevant question anymore. The kind of questions investors are asking is, okay, if tariffs change, what happens to my portfolio? If interest rates change, what happens to ETFs? How can I benefit from growth in biotech? What happens if exchange rate changes? So it's really these macro sector economic factors that are driving portfolio construction. And this old way of classifying ETFs wasn't really relevant to that anymore. So if I'm looking for dividend ETFs or if I'm looking for low vol ETFs, it's hard to find those in very traditional style boxes. And so really the way we've thought about it at CFRA is to say, how do investors really look for funds given these changes in the macro environment, given that they're looking for more thematic and quantitative factors, and therefore how can a classification system support that kind of analysis?
So, would you say themes and factors are the new way of classifying funds as opposed to the style boxes and the sectors were the way things used to be?
Sectors are still relevant. So I think sectors are still relevant primarily because it's easy to make a connection between sector ETFs and policy. If I know a policy is going to impact biotech, if I know a policy is going to impact industrials, then it's easy to find a biotech or an industrials ETF. So I don't think sector investing is going away. The problem is that it's not adequate. In other words, it's not comprehensive. And the reason for this is because many themes and factors cut across sectors. I mean, AI is the best example of this, right? There may be AI companies that fall into the technology gig sector. Some may fall into the communications services sector. Some may even fall into the healthcare sector. And so if I'm looking from a very traditional sector perspective, as an investor, I may miss these mega trends, these broader trends that cut across traditional sectors. And therefore, thematic and factor investing really have to be complementary to more traditional size-based investing as well as sector-based investing. That's not to say size-based investing and sector-based investing are going away, but they're just not comprehensive enough on their own.
So Aniket, I know CFRA has a very robust fund screener. We have one at ETF.com as well. These tools are so important when it comes to helping investors find the right ETF for them. What else do you think investors need to know about this topic of fund classification? Do you think it's going to continue to evolve from here? We're going to see new ways of classifying funds. Look into your crystal ball and tell us what you see.
The thing we really try and stay on top of is how is the fund industry evolving? I'll give you a couple of examples. We've seen, as you know, so much growth in the defined outcome of buffer ETF category. Now, investors or advisors want to be able to find those ETFs in a simple way. So we've actually classified them in a separate way. Now, again, we multi-tag them. So something may be buffer, maybe they also show up in some other category, right? But the point is we make it easy to find buffer ETFs. Similarly, as you know, single stock leverage ETFs have become important. Private credit is growing as a category. These are all new themes, new categories. There's so much innovation in our industry, which is exciting for us. And so the classification systems and the way people screen for funds and are able to screen for funds and build portfolios needs to keep pace with these changes. And that's the reason, I would say, in addition to factors and themes, we also want to stay on top of new product categories that are emerging.
Fantastic. Well, you gave us a ton of great insight, Aniket. Thank you so much for your time.
Thank you.